We are.
Yes, recording has started, I believe. So, should we start, Sumit? So I think first of all, good evening, everyone, all the participants out here, all the to our speaker for the day, C. Drishti Agarwal, to our special address by our my elder brother and my friend C. Sumit Bihani. So as today is, I think, 17th session, right, Sumit Bhaiya, of Golden Charcha.
Yes,
So,
yes.
so this is a very nice initiative by our EIRC, Golden Charcha, wherein we are covering a lot of relevant topics which are coming up, whether it could be income tax or it could be GST or it could be ROC, topics from different platforms. So to give a greater insights and practical insights about the topics. So as time is pressing, I'll not take much time as our speaker, C. Drishti, is there to cover all the topics. So I'll briefly introduce our special address for the day, C. Sumit Bihani. So Sumit Bihani is a FCA. He is a DISA qualified and he's a practicing chartered accountant. And he's a partner in MBRM and Associates since 2014. So it's 11 years of long-standing practice. He is holding a lot of accolades from the Institute of Chartered Accountants of India, which is including certificate in forensic audit and fraud detection, FAFD. He is concurrent auditor of multiple banks. He has experience in the field of internal audit. He has been providing shared CFO services for startups, and he's also conducting third-party audits. And he has been instrumental in the funds raising activity for client who has featured on Shark Tank India. Very good, yeah, Shark Tank India. He had conducted several seminars on generative AI, MS Office, and Google Workspace, which have helped 1,000+ finance professionals to automate small process and several man hours. We call Sumit Bhai as our AI man. We fondly call him. He has been also a co-opted member in the committee AI and ICAI for year 24-25, and he has served several committees of Eastern India Regional Council of ICAI. So we are proud, very proud to have you, Sumit Bhai. So with a round of applause, virtually, I would request Bhaiya to please for your opening remarks.
Thank you so much, Rahul. And I would like, first of all, like to compliment EIRC for, arranging an initiative like this. So the word is Golden Charcha. So let me bifurcate as Drishti would be speaking on income tax, and she'll try and, break down each laws into the interpretation. So let me break down the word, first of all, Golden Charcha, in case you have joined for the first time. Golden because it's the 50th regional conference we'll be celebrating this time, which is on 21st and 22nd of November. And Charcha because it's more of a friendly discussion where you can discuss your queries, considering the audience would always be a very limited, and it's more of a discussion kind of stage where you can ask your questions directly to the speaker. And again, it's a very good platform for young speakers to speak on or deliberate or start their journey. Drishti, is this your first session, or like how many sessions have you taken?
No, so it's my first session.
So she's making the best out of this forum. So a round of applause for her, first of all, for initiating and volunteering this, this
Thank you, sir.
journey or this legacy where as chartered accountant, we always believe that sharing knowledge is one of the key components of our profession. So I'll not waste much of time, but yes, as in we were initially, I and Rahul were discussing with Drishti that, is the government willing to, with so many of disclosures in the income tax return, is the government willing to discourage old regime? So as professionals, we have to always answer in a positive note. So it's not probably discouraging. It is asking you that in case you are claiming deductions, be very diligent while doing so, and be keep the documentations available with you. So simple case laws, as Rahul spoke, that I am keen interest in AI. So I'd like to just give you a small use case of AI, which is very much related to income tax. That somebody was claiming, and Drishti would compliment me in case I miss out something, that somebody was claiming the business, the capital gain expenditure, and while claiming, the authority denied that claim, saying that the expense bill which you are saying is in Calgary, and which has the front has been initiated post 2001. So this is the kind of learning and the mechanism the government have built. So please be very diligent in filling up forms. In case you have any discussions or any questions, make best out of the chat window. Though that's in virtual, I mean, this is a webinar as compared to a Zoom call. So I understand that asking questions may be a little difficult, but still, please make the best out of the chat box to ask questions. And I hope she will share a good knowledge with all of us. So look forward to this stream. So back to you, Rahul, for the next formalities.
Thank you, Sumit. Thank you for your opening remarks. So, for the session, we have a very young and dynamic speaker for the day, CA Drishti Agarwal, and I wish you the very best for taking the first session. So many more to come. So Drishti, so let me just briefly introduce Drishti. She is a chartered accountant who has qualified in May 23, very recently. She has completed her schooling and graduation from Kolkata, and she was inspired by her parents to pursue the CA profession. So by any chance, your parents are from CA background, Drishti?
No, sir.
Okay, that's great. So currently, she is working with ALP and Associates in taxation, valuation, and audit domain. She belongs to a supportive family wherein her younger sister is from a very different domain. She's preparing for NEET, NEET. So, with a great round of applause, Drishti, we welcome you to the floor, and the floor is all yours. So, please start. And I request the participants to be interactive. If you have any questions, so Drishti, what will be your comfort? Like, should we allow questions in the middle of the session, or should we take it at the end of the session?
At the end of the session, it will be more comfortable.
It will be more comfortable, right? So I would request participants to please take a note of your questions if you have any, so that Drishti would take up towards the end of the session, and that should be the process.
I
So,
think
thank
you
you,
can
Drishti. Over
write
to you.
questions as and when you feel like on the chat box, and the questions can be addressed once the session is being deliberated.
Right. So over to you, Drishti.
Yeah. Thank you so much, sir. First of all, greetings to everyone. Myself, CA Drishti Agarwal, as already introduced by CA Rahul Modi sir and CA Sumit Bihani sir. So, first of all, I want to thank to CA Vishnu Tulsian sir for introducing me and for engaging me to motivating me to come to this platform and start off my first webinar series. So here I am with the topic changes introduced in the new idea forms 1 to 7 for the assessment year 25-26 means for our current filing year 24-25. So, unlike in the last couple of the years, we have seen that the idea forms were released a quite bit early, probably in the March month around. But in the recent year, in the current year, we have seen that there has been a delay for more than a month. This creates an anticipation that the department may have to extend the due date to file the idea. So the current filing date for the ITR for non-audit case has been extended from 31st July to 15th of September 2025, and the belated return filing as well as the revised return filing date has been extended to 31st December, which was previously also 31st December 2025. So coming directly to the topic, first and the foremost topic of mine is changes in the applicability of the ITR form. The CBDT has amended Rule 12 of the Income Tax Rule 1962, particularly for salary class individual and small business class individuals who are having capital gain under Section 112A of the Income Tax Act. First of all, let me go through Section 112A of the Income Tax Act. 112A deals with long-term capital gain arising from the sale of listed equity shares or equity mutual funds or a unit of business trust. Previously, the exemption limit was around rupees 1 lakh, which have been extended to rupees 1 lakh 25,000 currently. Under the previous ITR form, if a person is having LTCG under Section 112A and it was within his basic exemption limit, then also such individual was not able to file ITR 1 or ITR 4 due to the presence of such capital gain. Now, currently, this made them more complex and it was difficult for them, resulting in genuine hardship to them. Now, currently, if a salary class individual or small business taxpayers are having LTCG income under Section 112A, they are able to file ITR 1 or ITR 4. They are not L. Even if they are having LTCG income under Section 112A, provided there are two basic conditions to consider that if a person is having such an income, first of the condition is that the amount of exemption is 1,25,000, and such a person should have LTCG income up to rupees 1,25,000. Second, and the most important condition is that there should not be any brought forward loss or capital or carry forward capital loss. This move makes an easy burden compliance and simplifies return filing to such small class taxpayer or salaried individual. Coming to my second topic is regarding changes in disclosure and opting out of the new tax regime of Section 115 BAC. We all know previously that if a person was opting out of a new tax regime, then he needs to file Form 10IEA before filing of his ITR. So we all know that if a person has not filed Form 10IEA, then he is not able to opt out of the new tax regime under Section 115 BAC. So, in the current ITR filing, we will see that the department is asking for confirmation whether the person is currently also opting out of the new tax regime. Whether the assessee is opting out, then also we needs to confirm whether yes or no, and he is opting out of the new tax regime. Coming to the fourth topic, the most important one, changes due to amendments made by Finance Act 2024 to taxation on capital gains. We all know about section 45.1. What does 45.1 means? If I go in brief description regarding 45.1, 45.1 says like if a person is earning capital gain, then the capital gain is taxable in the year the capital asset is transferred. This means that the date of transfer plays a critical role in determining the applicable tax provision. There has been an amendment made to this regarding capital gain taxation post 23rd July 2024 and pre 23rd July 2024. First, let me make you understand what was the taxation pre 23rd July 2024. Pre 23rd July 2024, if a person was earning short term capital gain under section 111A, then the taxation and the tax rate was 15% upon short term capital gain. But if the person is earning capital gain post 23rd July 2024, the tax rate have been changed to 20%. Similarly, if the person was earning capital gain upon sale of land or building, which was taxed under section 112, then the person needs to pay tax at the rate of 20% with indexation benefit. This was there pre 23rd July 2024. But post 23rd July 2024, a uniform tax rate at 12.5% will be applicable to long-term capital gain under section 112. Further, a grandfathering provision have been introduced for land or building acquired before 23rd July 2024. Coming to section 112A, the tax rate on long-term capital gain covering under section 112A have been introduced at a rate of 12.5% post 23rd July 2024. Before 23rd July, it was at the rate of 10% with the exemption limit of 1 lakh. Now it has been changed to 1,25,000. Similarly, the return requires a disclosure of the date of transfer, separate reporting for transfer made before or after 23rd July 2024. In the current ITR filing, we will see that the return are asking for a proper disclosure regarding the date of transfer, like reporting for transfer that has been made pre 23rd July and post 23rd July 2024. In the capital gain, I want to add this point as well. In the capital gain, we are required to give a quarterly breakup of the capital gains, like whether it was reporting in the first quarter, whether it was reporting in the second quarter, third or fourth quarter. Why is it beneficial for us? Because there is one benefit for this. The first and foremost benefit is like if we don't report it correctly, then our interest liability will arise. For example, if we have earned capital gain in first quarter and we are reporting in the fourth quarter, then our interest liability will arise, which will increase our tax. So that I need to add that like a proper reporting in the ITR, we should make it proper, ensure that our capital gain taxation should be disclosed proper and proper bifurcation, whether it has been earned in first quarter, second, third, or fourth should be there. Coming to the third topic, reporting of capital gain from unlisted bonds and debentures as STCG or LTCG based on transfer date. Before 23rd July, it was like if a person is earning capital gain on unlisted bonds and debentures. Like before 23rd July, it was like if a person has earned unlisted capital gain on unlisted debentures or bond, then he need to pay long-term capital gains, whether it has been transferred before 23rd July or purchased before 23rd July. But now in the case it has been if a person has purchased unlisted bonds or debentures on 22nd July, but it has transferred, redeemed or matured post 23rd July, then it will be taxable as short-term capital gains. Previously, it was long-term capital gains. Coming to the fourth topic, reporting of buyback proceeds as deemed dividend starting 1st October 2024. Like until 30th September, it was said that when a domestic company bought back its own shares, then the company had to pay an additional tax liability under section 115QA, and there would have been no additional tax liability arising upon the hands of the shareholder, means the shareholders was fully exempt under section 1034A, and the shareholder had no further tax liability. But from 1st October 2024, the entire consideration received by the shareholders on buyback of shares from the domestic company will be taxed in the hands of the shareholder. And the section upon which it would be taxed, it is said to be the section under section 222F, means it would be considered as deemed dividend in the hands of the shareholder. As a result of which, the shareholder will have to pay an additional tax upon this, and the full amount of the buyback will be considered. For this, I can add regarding your computation of capital gains. For the computation of the capital gains, the consideration amount will be considered will result to notional capital loss. Coming to the other topic, reporting of disability certificates for deduction under section 80DD and 80U. We all know that for claiming of deductions in the section 80DD and 80U, first of all, let me make you understand what is 80DD. 80DD section is available to any resident individual HUF who incurs any medical expenditure or pays any insurance premium. This deduction is also available to a dependent relative of such SSC who is the assessee must be suffering from any disability or severe disability, and such a dependent relative is paying an insurance premium or earning any medical expenditure upon taking treatment of such assessee. 80U deduction is available to only those assessees who himself is suffering from any disability or severe disability. In the previous ITR filing, we have seen that the taxpayers could enter the acknowledgement number of Form 10IA. Now, let me make you understand what is Form 10IA. In certain cases where the assessee or his dependent is suffering from any specified diseases, like specified diseases are already notified, there are certain examples which I can make you through, like certain diseases like autism, cerebral palsy, or multiple disabilities. Then he is required to obtain a certificate issued by the medical authority in Form 10IA. And for the other type of disability, he can only take a declaration from certain parties for issuing such a certificate. Like in the previous ITR filing, the person who has been suffering from certain notified diseases, as I already explained to you, then he needs to file Form 10IA, and in the ITR, he needs to disclose the date of the filing and the acknowledgement for the same. And for the other diseases, it wasn't required to him. But for the current ITR, if a person is claiming such reductions, then he need to file Form 10IE and he need to disclose certain acknowledgement number for filing of the same. So, like if the person is taking the benefit of the old tax regime, then it's compulsory for them to file Form 10IA so that they can take the deduction for 10, 80DD and 80U. But for if the person is claiming the benefit of 80, for if the person is claiming the benefit of new tax regime, then obviously he will not get the benefit of 80DD and 80U. Coming to the other topic is Schedule AL. In Schedule AL, we need to disclose the assets and liabilities held by the assessee as at the end of the year. So the limit was that if the assessee is earning a total income up to rupees 50 lakhs, then only he is required to file Schedule AL. But now this limit has been extended from 50 lakhs to 1 crore. Means if the total income of the assessee is more than rupees 1 crore, then only he is required to file Schedule AL to disclose his assets and liabilities as at the end of the year. So I think this is one of the major changes which have came in the ITR forms. Now let me make you go through to certain other points. Like first of all, I want to give you certain filing tips. So like filing tips, first of all, the most important filing tips is like to verify your AIS, TIS and 26AS with the documents which we have received from the SSC. It is of utmost important to us to check whether the documents which we have received from the SSC, for example, a salary class individual has given us his form 16 to to verify it and to file upon his ITR. So we need to check whether the form 16 amount, whether the amount reflected in 26AS, whether the amount reflected in AIS, TIS must reconcile, and check whether all the amounts are same. And it's our duty to check the correct amount is reported in the income tax return to ensure that all the income and tax details are properly shown in the ITR. Then the most important thing is to check which ITR to file. It's very much important to check which ITR form needs to be filed. After this topic, I'll let you know the different types of ITR and which ITR form needs to be filed for each and every cases. Third, there are different types of e-verification method. Like the most important and most easiest e-verification method for me is like Aadhaar OTP. Just we need to ask the client for the OTP and the process is done for e-verification. But there are other methods as well. For example, if sometimes Aadhaar PAN is not linked or it's not linked to your phone number of the assessee, then we have certain difficulties to ask for the OTPs with the client. So it is like we can also proceed with e-verification later mode. In e-verification later mode, there is only one process we need to follow. Is like we need to file the ITR, and after filing the ITR V acknowledgement will get downloaded. And for with that ITR V acknowledgement, we'll need to speed post it to CPC Bangalore. The address is mentioned over there. The fourth most important is like pre-validated bank account. Before filing of the ITR, we need to check whether the bank account which we are showing in the ITR to select our refund account has been pre-validated in our income tax portal. This is utmost important to us to know because sometimes it might happen that return has been processed, everything is all right, but refund is not getting processed. Just because of the reason is like कि our bank account is not properly validated, the main issue which arises. So we need to check that before filing of the IT and before selecting the bank account on which our refund should get credited is properly validated to ensure it is done correctly and to avoid any refund failures. Excuse me. There are certain more enhanced disclosure requirements. Like moving to the first utmost enhanced disclosure requirement is of house rent allowance. Like for the new regime, if we are like for new regime, it is not possible for us to claim any house rent allowance. But if a person is filing return in his old tax regime, then it's possible for him to take house rent allowance. The taxpayer claiming HRA exemption needs to provide more details. Currently, like the details which are required, I can explain it to you. Like we need to disclose the place of work, actual rent, actual HRA he is received, and amount of rent he is paying. Secondly, for home loan interest. Home loan interest is also asking for enhanced disclosure and also required for claiming deductions on home loan interest. There are certain disclosures which are being asked, like sanction limit, issuer of loan, loan account number, date of sanction, loan outstanding, interest on borrowed capital. So we can see in old tax regime for claiming such deductions, they are asking so much disclosures so that no bogus deductions are being claimed and all deductions are properly verified, then only we are asking for such deductions with the department. For section 80C deductions, if we are claiming an 80C deductions, which was previous a simpler entry, like we used to put up rupees 1,50,000, but now taxpayer now need to provide many specific details of their investments. Then only it would be possible for us to claim section 80C deductions. Instead of that, it won't be so much easy to get the refund. Now, coming to the other topic, withdrawal of the new income tax bill. Withdrawal of the new income tax bill, like it's very much important and one of the most Charcha card topic. It's important to know that the new income tax bill, which was introduced and was intended to replace the existing Income Tax Act 1961, was recently withdrawn. And a revised income tax bill will be released in the upcoming 4 days. But for the current filing for the assessment year 25-26, there had been no changes and it is based upon the existing laws and the new default regime. Like no other changes for the income tax bill would be prevailing upon our filing process for the financial year 24-25. Then coming to the other topic, like faster processing of refunds and early refund. Like we have seen, the average time for processing income tax refunds and issuing refund has been drastically reduced in this current year. As per official data, the average refund time has dropped from an average of 93 days in financial year 13-14 to as low as 17 days in recent year. This is a major step towards making the tax system more taxpayer friendly. Now coming to the other topics. The other topic is regarding the income tax forms. Like I can share my screen for that. Just wait a minute. Yeah. Uh, this is the nature of income, and these are the type of the idea forms. Like I can just overview regarding this. Idea one is also known as Sahaj, and idea four is also known as Sukam. Do you know why it is known as Sahaj? Idea one, why it is known as Sahaj? Because it is much more easier written. It is like hassle-free written. Like a normal SSC, if he wants to file it upon his own, he can proceed to that. So idea 4 is known as Sugam. And idea, so let me go through it. Like idea 1. Idea 1 is basically filed by income from salary or pension for ordinary resident person or income from loss from one house property. If a person is having income or loss from one house property, excluding brought forward losses and losses to be carried forward. And currently, if a person is having, this is the major amendment which I was talking about, that if a person is having a long-term capital gain taxable in a section 112 way and it doesn't exceed rupees 1.25 lakhs, then a person can file ITR 1. So this is one of the major amendment. Like if the person was having capital gain and if the person is having capital gain and his income was within the basic exemption limit previously, then also it wasn't possible for him to file ITR 1. He need to file ITR 2 or ITR 3. But currently, due to this amendment, the small salary class people can file ITR 1 as well. If a person is having any brought forward losses or losses to be carried forward under the individual, under the head in house property, then it would be possible for him to file ITR 2 or ITR 3. Or income or loss for more than one house property, then also he needs to file ITR 2 and ITR 3. The other topic, like yes, if a person is having an agricultural income exceeding rupees 5,000 or his total income exceeds rupees 50 lakhs, and assessee has any brought forward losses or losses to be carried forward under any other head of income, then also he needs to file ITR 2 or ITR 3. It won't be possible for him to file ITR 1. And we all know that ITR 5 is filed by any partnership firm, AOP, LLP, or local authority or artificial judicial person, whereas ITR 6 is filed by companies and ITR 7 is filed by trust. So these are the main ITR topics, and these were the major main ITR amendments which have been come across. Hello? Hello? We can proceed for the questions if there is any questions like that. Hello? Rahul sir, am I audible?
Hello.
Hello, Rahul sir, am I audible?
Yeah, one second, Drishti. Yeah, audible.
Yeah. So I have covered the major topics. We can proceed for the questions if any.
Okay. So request all the participants, if you have any question and answer, you can write in the chat box, or else I can unmute. So if you can put a question in the chat box, and Drishti will be replying to you. May I request EIRC to please unmute everyone for the question and answer round. May I request admin to please unmute everyone for the question answer round? Yeah, I think there is some issue. So I think there is a question. There is a question, Drishti, like if a person is having capital gains on sale, if shares above 2 lakhs, which form should he use?
Then he must proceed for ITR 2 because for ITR 1 there is limit of 1.25 lakh. If the person is having capital gain under section 112A, if he is earning long-term capital gain, then ITR 1 is there, but the limit is 1.25 lakhs and there should not be any brought forward loss or any carry forward of capital losses. But if he is earning rupees 2 lakhs, then it would be possible for him to file ITR 2.
So I think you're trying to say that that after the threshold limit gets exhausted, ITR 2 has to be filed, and up to a limit of threshold limit, ITR 1 is to be filed.
Correct.
Okay. So any other question from the participants? I think Drishti has done a superb job out there. That you have left no questions unanswered. You have delivered in such a way that there has been no question as such only. So much pain. I'll just wait for 2 minutes more. Like if somebody has question.
Yeah.
Otherwise we'll end up the session. I think one question has come from Bhavesh Misraji. A capital gain position in respect of mutual fund. Okay. So I think basically he's trying to ask that in case of redemption of mutual funds, what would be the taxability of capital gains? I think that is the question you're trying to ask, Bhaveshji.
Bhavesh, can you explain a little bit like what is your exact question? Like if it is a listed equity oriented mutual fund, then it would be covered in section 112A. And if it is a debt oriented mutual fund, then a normal tax regime would be prevail upon it.
If it is equity oriented mutual fund, I think
112A.
112A, so 1,25,000 limit will be applicable. And post that non-normal taxation would apply as it applies to normal shares, right?
Yeah, and if it would have been debt-oriented mutual fund, then normal taxation.
Right. So hope the answer hope the answer was okay to Bhavesh. I think he got the answer.
Yeah.
So any more questions from the house? Something like that. Okay. So I think there are no more questions.
Yeah.
So let us wrap the session. So I think it has been done excellently well, Drishti. So first of all, I would like to offer a warm gratitude on behalf of EIRC and on my personal behalf that you have explained the return from future really very wanting session. Like if we all are rushing towards filing of returns. So this is in right now. So everybody has questions in their mind because I think after so many years there has been changes in return forms.
Correct.
Because normally these changes there used to be little changes here and there, but this time they have come up with multiple changes after a very long time. So we need to file it very precisely. And as I think Drishti has covered, that this time department has used backend AI tool. So
Correct.
we need to file returns very cautiously. Otherwise, we should be ready with getting notices, and definitely our client will not pay for it if it is done erroneously. So we should be very careful while filing returns. Even we should be asking data from the clients. Even if in case they are not providing the data, we should be insisting on. But we should try that we should not file bogus returns, which in many
Yeah,
cases it used.
yeah, if we're claiming return in the old tax regime, then it would be beneficial to disclose each and every acknowledgement number if we're claiming any deductions. Unless that acknowledgement numbers, it won't be possible for us also to claim the deduction. So we need to make an ensure regarding that.
Right. I think I would put a request also before all the chartered accountants are here only, that many times what happens is that clients provide the data verbally, that this is the acknowledgement number, this is the acknowledgement number, and we claim reduction just for the purpose of filling the column. But that will I think that will not be, that will not be taken, that will be well taken care this time, as AI is very much in the back end. So it will be safer to get the documents in support of the deductions which you are claiming,
Documentation, correct.
so that whenever if we have documents, so we will not be in trouble in times to come. Otherwise, we will be in trouble in times to come. Client will be harassed definitely, but it will be harassment for us as well. So it would be a genuine recommendation and advice. So thank you so much, Drishti, for a wonderful and insightful session. We will be definitely looking forward to have more such sessions with you. Thank
Okay,
you.
thank you, sir.
Thank you,
Thank you, sir.
Drishti. Thank you, participants. Thank you.
Thank you so much.
Validation successful.